Thank you so much for joining us this morning for the 1031 Tax Deferred Exchange webinar. Let's jump right in. Flow of today's discussion is going to be around, we'll first get introduced to what is 1031 exchanges, right? So you may have heard about it, but there are so many nuances to it. We will cover an example, and then we'll jump into what is the process of doing a 1031 exchange. The third thing that we'll touch upon, and I think that is the most interesting piece here, is how do you combine 1031 exchanges with the 121 revenue code? So essentially, the 121 revenue code is that if you are selling your primary residence, you can take a certain amount tax-free, right? So, but we'll get into details of that. How do you combine the two? And then the third piece is how do you exit from a 1031, right? Like, because this is tax deferred, it's not avoiding taxes, but what's the exit? How do you get out of it? And then we will touch briefly on what is a qualified intermediary and how do you choose one? How do you know you're choosing the right QI? If time permits, we will get into 1031, the types of exchanges. I don't know if we're going to have time in the next 50 minutes here. So that's what we're going to cover. And let's dive in here. Paul, can you tell us a little bit about what are 1031 exchanges?
Absolutely. Yeah, so a 1031 exchange is a way to defer your taxes on investment property. The key is it's a deferral of taxes. So it doesn't eliminate your taxes, but it is a way to defer your taxes when you own investment real estate. So investment real estate can be any sort of property that you own that receives income. So a single family residence or a single family property that has a rental income qualifies for a 1031. Commercial buildings will qualify for a 1031. Vacant land can qualify for a 1031. So again, a 1031 is a way to defer your taxes when you're selling real estate. And what it does is it actually helps you retain and have higher buying power when you are purchasing what we call the replacement property. So there is a way to be able to purchase your new property. There's some steps you need to take, but you are able to keep all the equity that comes out of the transaction and replace it into a new property without having to pay any taxes on that transaction. So it is a great way to, we talked about, build wealth and to leverage the money that you would normally have to pay in taxes to buy a larger investment property so that you can receive more monthly income. So at the end of the day, the goal is to be able to buy a better performing or higher performing investment property that receives more income on a monthly basis.
Perfect. And we'll get into the nuances of this. And I know we're going to cover a lot of jargon here because it has a different terminology altogether. So maybe let's jump in and understand the jargon first and some terminology on 1031 exchange.
Yeah. So you'll hear a lot of terms when it comes to a 1031. So there's a lot of different topics and a lot of different terms that come out of a 1031. And, obviously the exchangers. So when we talk about who the exchangers are the people that are selling the property and that are going to be buying the new property. So they're ultimately the property owner that is going to be deferring their capital gains. You hear the term relinquished property a lot when it comes to a 1031 exchange. Relinquished property is the property that the client is selling. So that is their relinquished property. So we'll call that their RP, their relinquished property, or RQ. The replacement property is the property they're going to buy. So when they have a 1031, there's a new property that they're buying on the second transaction, and that's called the replacement property. Boot is a very big term we use quite often. Boot is what is basically cash coming out of a 1031 transaction. And why it's called boot is it becomes taxable. So if you take cash out of a 1031 transaction, boot is taxable. So you might hear that term boot at times. Like-kind property is something I mentioned. Like-kind property is basically investment real estate. It's any type of investment real estate can be used in a 1031. So it qualifies. So again, you could sell a single family residence and you could buy a retail building. That qualifies as like-kind property because both properties are investment properties. Certain types of properties don't qualify. We'll go into that later. But ultimately, you hear the term like kind a lot. And sometimes that's a term that can be misunderstood. So people will think, well, like kind means if I sell a single family, I have to buy a single family. So that's not the case in a 1031. As long as the property is held for investment, it qualifies as like be sold, and you can buy a office building. You could sell an office building and you can buy a single family piece of property. So as long as it's an investment, it qualifies. And then taxable gain is something that is very important in 1031s because that's ultimately what you're avoiding or deferring is that taxable gain. And we have some examples later on down the line that talk about how much in capital gains you could end up having to pay and how significant of a loss, well, not necessarily a loss, but how much goes to the government that you could take advantage of keeping. And then tax basis. Tax basis in a 1031 exchange is extremely important because you need to know what your tax basis is when you're getting into the transaction. You need to understand what your original cost as well as some of the improvements that you've made so we can really dial in on what your total capital gains would be if you sell a property and you cash out. So tax basis is very important, knowing what that is when you do a 1031.
Yeah, and I think given tax basis is such an important concept, let's double click into that so that we understand, hey, what do we need to pay taxes on?
Absolutely. So what your tax basis is, like I mentioned, your tax basis is basically what you paid for the property, plus your capital improvements you've made on the property over the years. And then the depreciation you've taken is subtracted from that. So basically, this is how we start understanding where your capital gains could be. So you look at what your purchase price is. And in this example, let's say you made a purchase price of $100,000 on a new property. And then you put in $20,000 of improvements on that property. So now you're at $120,000 of a tax basis. Now the depreciation, which is something we can talk about later, but depreciation is a tax advantage you have on investment property that you can write off every year. But the depreciation that you write off every year on the property is subtracted in this example. So that's how they factor your basis. So they subtract 10,000 of depreciation that you've taken. So now your actual adjusted tax basis is 110,000. So this property now, you purchased it and your basis is 110,000.
Perfect. And I know that tax basis is critical because, you know, even if you don't have equity there, go ahead.
Yeah, so tax basis, again, is very important because we want to know where your tax basis is because the IRS looks at the tax basis and that's in your sale price. They look at those two factors, right? So if you, in that example, we had a tax basis of $110,000 on this property. If you turn around and sell the property for $510,000, your gain is $400,000. Even if you have a mortgage of $400,000, the IRS doesn't take your mortgage into consideration at all. They look at what your basis is and what your sale price is, and everything in between is what capital gains. So again, in the example, you have $110,000 tax basis. You sell for $510,000. You will get $400,000 in capital gains taxes. And so why that's important again to know is, as we just alluded to, you potentially could owe more in taxes than you're going to get out of the property in equity. If you have people that have leveraged the property for many years, had taken advantage of the low interest rates, and again, let's say they refinance this property, and you're selling it for $510,000, but they have a loan for $410,000, so they're only getting $100,000 of cash out. A lot of people think, great, I'm still going to get $100,000 of cash, not bad, and I'm going to pay off this whole loan. Well, that $400,000 of capital gains, because remember it was 110 basis and 510 sale price, that $400,000 capital gains is going to get taxed around 20 to 30%, depending, could be even more depending on what state you live in. So let's even just say 30% at 400,000. You're looking at, what is that? 20% even would be 80,000 of capital gains taxes. So if you walked away, you thought you were walking out with $100,000 of cash, but you're going to owe $80,000 in taxes. So that's why it's really important to understand what your basis is, to understand how that can affect your property when you're selling it. Because again, a lot of people, this is a misconception where, well, I'm selling, I took a loan, I'm only going to get $100,000 in cash. I'm only going to get taxed on that $100,000. Again, the IRS does not care how big your loan is. They care what your tax basis is and what your sale price is.
Perfect. And I think that brings us to
Shilpa, are we taking questions in the middle? Just wanted to check.
So Pallavi, anybody has questions, just put them on chat and we will cover them as they come, or as appropriate, because we may be answering some of them later, but just put your questions in chat and we'll cover it, just so that we maintain the flow. But yes, please, everybody, put your questions on chat. So I think that brings us to the next question around, hey, what amount of tax are we talking about, right? So there's federal, there's state. Can you just
Yeah,
cover
absolutely. So federal tax is 15 to 20%. So, and that's based on your income. I believe right now it's as a married couple, if it's over 425,000 combined income, you go up to that 20%. The depreciation recapture, which I mentioned. So a lot of people don't understand what depreciation or know what depreciation is. So depreciation is something, again, that is a tax advantage you can take on investment property. So every year you can depreciate that property, and it's basically a write-off, right? And so the depreciation you take over the years is taxed at 25%. And if you own a property for a long time, the whole amount of that property of your purchase price will be depreciated. So if you buy it for, say, $300,000 and you own it for, like, I think the maximum now is 23 years that you can depreciate, it'll depreciate that whole 300,000. And so you would owe 25% on that depreciation. So it's a pretty hefty tax that people aren't aware of. There's also the 3.8% tax on for the Affordable Health Care Act, which is taxed on real estate. And then every state has their own income tax. Washington, thankfully, has a 0% on real estate sales, which is great. But California is about 13%. So I usually tell people who are selling in California that you're probably looking at close to 40% on capital gains taxes when it's all said and done. Because California not only taxes you at 13%, they take your total capital gain plus the amount of depreciation you took and tax you at 13%. So, and I mentioned, let's say an example, you took 300,000 of depreciation, and you have $400,000 in capital gains. California is going to tax that whole 700,000 at 13%. So, again, if you're selling an investment property in California, you probably can look at 40% right off the bat going to the government.
And I think the interesting thing here was when I first saw this, I'm like, hey, why should I even take depreciation? Because depreciation is going to be taxed at 25% when I sell. But Paul, when you and I spoke, you said irrespective of whether you take depreciation every year or not, the government is still going to hit you with this, or the IRS is going to hit you with this at the time of sale. And you may have to go back and fix your taxes for the previous years if you decided not to take depreciation. So
right, that's one of those weird things, because people sometimes don't even realize they can take advantage of depreciation when they're doing their taxes, and they never taken depreciation on the property, but the IRS will still hit you with that depreciation recapture tax, which is crazy, but they do it. And I see some questions. I don't know if since it's about depreciation,
I think we should.
Can depreciation only be applied towards rental and real estate capital gains tax, or all income? So depreciation, depreciation can be applied towards other things. You can depreciate depending on, and I'm not a CPA expert, but like your vehicle, if it's used for business purposes, certain types of business, personal property that's used towards your business can be depreciated, but it can only be applied towards investment real estate, not your primary residence. So I hope that answers that question.
There's no, it cannot be. It's only towards anything that's giving you income you can potentially.
Correct. And then can we have details on what all is covered as capital investment? So any capital improvement, absolutely. So you definitely want to keep the receipts and understand what you've done as capital improvements. And obviously that's hard. Many people have owned properties for many years. Any sort of capital appreciation or improvements, would be anything that you've done to the property to improve it, really. Any sort of painting it, adding on to it, changing the carpets, all those type of things that you've done to improve the property over the years is considered capital improvements. And so those would bring up the basis. So it is important to keep track of that, especially when you own investment real estate, because you want to make sure you have a good sense. Again, that's going to benefit you at the end of the day, because that's going to lower your taxable gain, because it's going to bring up that basis. So the higher the basis, the better. Especially if you go in and you buy a property and it needs a lot of work, you're putting in a lot of capital improvements in that property. That's going to bring up your basis. So it is very important to keep those records.
Perfect. Now from here, I think let's jump into making it real and let's talk about an example and see how that really works. So I've taken an example of the Sehgal family, married filing jointly. And to keep it simple, let's say they have no other taxable income. They bought a multifamily unit for 10 years back in 2014 for about 1.5 million and now are looking to sell for 3 million. They did capital improvements for around 200K. There was depreciation that was taken over the years. But the key here is that they leveraged their investment and have almost 2 million to the bank. So now in this case, how would that really pan out, Paul?
Sure, absolutely. So in this case, if you're looking at, to start the numbers, so their original purchase price was $1 million. They, as we talked about, the improvements of 200,000 brings up the basis, but the depreciation they took over the years lowers your basis. So in this example, they have a net adjusted basis of 1.1 million. So the purchase price again was 1.5, but because they've taken so much depreciation, it's actually lowered their adjusted basis. So that's where they sit right now at 1.1 million. And so they sold it for 3 million. There's closing costs in an exchange. So closing costs would include realtor fees, realtor commissions, escrow title fees, R fee, a number of fees qualify to bring down your sales price to give you a net sales price. Even if you might have an attorney or a CPA that works directly on the transaction, which I strongly recommend a lot of times, those fees will be considered exchange expenses. So in this example, they came out with a $2.8 million net sales price. And after taking out the adjusted basis, they will walk away, or they have a capital gain potential of 1.7 million. So in this example, these people would be looking at potentially paying taxes on 1.7 million. You can go ahead.
Yeah, and I think the interesting thing to note here is while they would be paying taxes on 1.7 million and they will get just 800K in hand, because they still owe the bank about $2 million. Yeah,
that is sorry, that's a very big point. In this example, they were only going to walk away with about 800,000 in cash because they owed the bank 2 million, so they paid it off. And so, is this one able to? I'm going to shrink this down a little because I can't see all of it. There we go. So after all that's said and done, as we talked about, they are looking at the depreciation recapture tax and all the taxes that are going to be potential on this transaction. So remember, with one big thing here, they were only walking away with 800,000 in cash. So after paying off their loan and everything, they only have 800,000 in cash. But some people just don't understand what they're going to get hit with in taxes. So in this example, they took $600,000 of depreciation. Remember, we talked about federal government will tax that $600,000 at 25%. So they owe $150,000 in depreciation. The appreciation, or the capital gains tax, as you see here, I'm sorry, the number was 479,000 or above. So in this example, they get taxed at the first 479,000 at 15%. So that equals $71,000 or almost $72,000. And then the additional amount above the 479 is taxed at 20%. So there's another 124,000. And then the healthcare tax at 3.8 is 55,000. Now, this example gives a state tax of 5%. We kind of hit in the middle on this one. So your federal tax is about 400,000. If you add in this state tax, you're looking at about almost close to $490,000 in taxes. And again, the powerful part of this is they walked away with 800,000 in equity. So they're giving up over half of that equity to the government. So they're only going to walk away in this transaction with just over $300,000 of cash. Now, that's nothing to be upset about, but you did give away a lot of that money. And this is where the 1031 is so powerful and why you could take advantage of it.
Yeah, and I mean, if you look at this example, the blended tax rate is around 28%, whereas from a cash out perspective, it's more than 50% because you still had loans to pay off.
Yep. So if you look at the difference of a sale and an exchange, so we like to look at this because it's, again, in this example, they're still walking away with almost $315,000. That's a nice amount of money. But if they were looking to purchase a new property, right? If they don't do a 1031, their purchasing power is only going to be about 1.2, close to maybe 1.3 million, because that 313 is about 25% down. Now, if they took advantage of a 1031 and rolled that whole $800,000 into a new property, they could reinvest up to about 3.2 million. So a lot more purchasing power, a lot more to be able to take advantage of, and it hopefully is going to get them a property that's going to bring in better income. Because a lot of reasons why people are exchanging is to build their wealth, bring in better income. Maybe the property they are selling needs a lot of work. We talked about this being a multifamily property. So maybe they're taking advantage of doing a 1031 and getting out of that property and getting into a better, more up-to-date property. Diversifying into a different market. Lots of people are moving. Again, I live in the Bay Area. A lot of people are leaving the Bay Area. They're going to different markets. And a lot of people who go to different markets like to bring their investment property with them. So you might have if they're moving to Washington from California, they may have $3.2 million in purchasing power. That can buy a lot of properties, in a lot of areas. So it's really, really good to take advantage of the 1031. And again, who wants to give the government almost $490,000? That's a lot of money. And there's a lot of things you could do with that additional cash.
And I think one thing to note here is that when you're buying a replacement property, you have to buy it at the amount of the fair market value of your relinquished property. So in this example, if I'm selling my property and it was worth 3 million, even though I just walk away with 800K there, I have to buy a property for 3 million or more.
And we'll talk about that because then we're going to go, I think, into some of the rules of the 1031. But what we really wanted to set the stage for is why do a 1031? And really at the end of the day, it's to avoid paying, this much in taxes. It's really a way to defer those taxes. If you want to continue to build wealth and you want to continue to take advantage of this, the 1031 is a great way to do it.
And it will also improve your cash flow going forward, because the higher the property you buy, you get more rent. And there are some numbers here that Paul is sharing on that as well. So,
yep.
So I think we do understand, Paul, the importance of 1031, but let's now jump into say, what's the process, right? What does it take to do an actual exchange?
Absolutely. So we talked about this earlier, like-kind property. So the first thing for it to qualify for a 1031 exchange is it must be an investment property. So when I get calls from folks saying they're interested in doing a 1031, that's my first question. Tell me about the property. Is it an investment property? And this just kind of goes through all the types of properties that qualify. Surprisingly, a lot of things like cemetery plots, different types of properties do qualify because they are so vacant land is kind of a unique situation, but vacant land is one of those properties that, even though it doesn't receive income, still qualifies because it has the potential either to be fixed up, a property put on it, or used for purposes to receive income. So that's the only property on here that you might question and say, well, how is that an investment property? Because it's a vacant land, it doesn't receive income on a monthly basis. It has the potential for it, so it does qualify. So that's the first thing to be aware of. It must be an investment property. So we alluded to this just a minute ago. In order for it to be a fully tax-deferred exchange, you must buy a new property equal or greater in value to the property you sold. So in the example we just used, that property they sold was $3 million. Remember, there was a net sales price of 2.8 because of the closing costs. So the client must buy a property at least 2.8 million or more. And any cash that comes out of the transaction, so in that example, again, 800,000 in cash came out of the transaction, they need to reinvest all of that. That makes it a fully tax-deferred exchange. They can't receive any money, and they must replace the debt. So they had a $2 million debt. They need to get at least a $2 million debt or more. Now, the common misconception is if I don't do this, if I don't buy equal or greater, I can't do an exchange. That's not the case. You can buy down in value. You can take cash in an exchange. It's okay. Just the amount you either buy down or the amount of cash you take is taxable. So sometimes people will say, hey, I want to take $100,000 in cash, or hey, I can't find anything 2.8 million or greater. It's okay if they buy down or if they take some cash. It's just that amount they take is taxable. And then here's some important facts on a 1031. So the rules of a 1031. So when you sell your property in a 1031 exchange, you have to ID the new property that you're going to buy. So it's required that you ID in writing to a third party what properties you intend to buy. And the IRS allows you to ID up to 3 properties, and you can choose to buy 1, 2, or all 3 of those properties. The other option you can use, which is called the 200% rule, is another way to be able to identify more than 3 properties. So sometimes I mentioned people that move markets, they may be moving to a market where the purchase price are lower, and they want to take advantage of that, and they want to buy 5 or 6, single family properties. This 200% rule allows them to do that because they can ID up to 200% of the value of the property they sold. So go back to our example, they sold for $3 million. They can ID up to $6 million worth of properties. So they could ID 10 $600,000 properties throughout Washington. Most common rule we see is a 3 property. People can ID up to 3 properties regardless of their value. So they could ID a $10 million property, a $15 million property, and a $6 million property. Doesn't matter what the values are, but they can ID up to 3 of them. They can choose to buy 1, 2, or all 3. So those are the rules. So the IRS does require that you have them in writing and signed. And the next slide will tell the timing of that. So we have to receive that within 45 calendar days of the closing of the relinquished property. So in a regular delayed exchange, your clock starts ticking on an exchange once you close escrow. So if you close escrow on June 1st, you have 45 days from that day, from June 1st, to identify in writing to us or to a third party what your intention is to buy. So what your replacement properties. And those are calendar days, so they include weekends and holidays. And then you have a total of 180 days to close on those properties. These are set in stone. The IRS does not budge on this. We have to have it, and we as an intermediary will put this in a file, so it's all properly documented that when we received it. We go and review the ID form that you send to us, so there's no questions. So it's all properly identified because you have to give us a full address. We have to really know, it's got to be specifically identified. So, and then you have, again, 180 days.
So just to summarize this then, right? So basically we need to, your property value should be equal or higher. You should have identified what you want within 45 days. And then, yes, you can get extensions, but you have to have identified those properties that you want to close on. Right. So I think that's right. The key summary on what's critical, and that has to be met.
Right. Yeah. So those are the main things to be aware of when it comes to a 1031 exchange.
Yeah, Neha, you have.
Yeah, it's a question. So if suppose we have an investment property in a different country, and I'll give you the example in Australia. So we have an investment property there. We are selling that off. Now, as we have to pay capital gains tax in Australia, is there any kind of agreement between US and Australia where you can leverage 1031 or similar thing?
Unfortunately, no. It's got to be United States real estate, both for your sale property and if you're buying, looking to buy a replacement property. It's got to be in the United States.
No, this is helpful. Thank you.
Yeah. But there is some things we're going to talk about here in a minute that we'll get to that we can take advantage of that you might be able to.
Sure.
Okay. So any questions, guys, keep putting it on chat. So then we know if it's coming up, we'll cover it. Right. So
yeah. And so these are, I was just going to talk real fast. Those are the rules. I know it's a lot to cover in a short period of time. Ultimately, the biggest thing with the 1031 is just knowing, who to reach out to. Reach out to your realtor right away if you're considering doing it. They can contact me. I walk you guys through the process. I walk your clients through the process. I make sure everyone's comfortable with what the transaction is going to be, and make sure if there is any red flags, we identify them right away, so we can get those in order before they close escrow. And then the last big point on a 1031 is, and I'll talk about it a little bit later, but get your qualified intermediary involved. The sooner the better.
Yeah, and I think the key is it cannot be an afterthought, because if you close your escrow today, and you take the money, you do not qualify for the 1031. I know a lot of us are from India here, and I know the rules there is that you have about a year to go invest, and you can take the money out and you can do whatever you want with it. That's not the case here, right? So your QI or your escrow, think of them as an escrow. They have to be involved before you even close your property, because the money doesn't come into your account at all. It has to stay in the escrow account, right? So
the worst call we can get is, hey, I closed escrow yesterday. Now I think I want to do an exchange. We can't go back. So we have to be in place before you close escrow.
So I think now we'll get to the most interesting part, I think, of this discussion is how do I combine 1031s and 121s, right? Like if I have a primary residence, I know I can get some tax rebate out of that, but how do I, and if I rent that out for 2 years, how would that pan out?
Absolutely.
And I wish I knew this back, you know?
Yeah. So your primary residence exclusion, everyone qualifies for this primary residence exclusion when you own a property for 2 years. It's as a single individual, it's $250,000. As a married couple, you get $500,000. Now, the beautiful thing about this, it's an exclusion. It means it's not deferred. You get this cash. So when you sell your primary residence, you get this $500,000 right off the top, which is great. You could take that, you could pay off debt, you could do whatever you want with it, but you do get that $500,000 when you sell your primary residence. Now, there is a way to take advantage of both the 121 and 1031. And what it is basically turning your primary residence into a rental. And so you live in it at least 2 years during a 5-year period. And then if you sell, you can take advantage and get both the $500,000 exclusion, and then you can 1031 the remaining amount and continue to build and defer taxes. And why this is important, I'm sure there's a lot of people that have bought properties and own them for quite a while. We're seeing a lot of appreciation in California. We're seeing a lot of appreciation in Washington. And sometimes you're well above that 500,000. Right? So you've gone way over the $500,000 exclusion. And so at this point, you're wondering, well, geez, if I sell, I'm going to get 500,000, exclusion, but I'm still going to pay taxes on let's say you've got, $900,000 in gain. Well, I'm going to have to still pay taxes on this 400,000. So again, in states like California and other high tax paying states, you're going to lose 40% of that. So you're going to have to pay taxes on, 40%, which is going to be $160,000 in taxes. That's a lot. So people are wondering, hey, how can I take advantage of this? So there is a way to be able to combine both the 1031 and the 121. So again, as long as you've lived in this property at least 2 years out of the 5-year period, it starts to qualify for both the 1031 and the 121. So go ahead.
Sorry, it's refusing to.
So I think we have some examples. Yeah, no problem. So I think we have some examples of how this works. So again, in this example, under both, you can do both. You can qualify for both. So they must have been occupied for 2 out of the last 5 years as a principal residence. You get that $500,000, and then you exchange the rest. So this is, I think the next one gives us an example of how you can take advantage of it. So in this example, we have a residence that was bought as your primary residence for $200,000, and in 2015 they converted it to a rental, and then in 2018 they sold it for $860,000. So they qualify because they bought it in 2000 and they lived in it, and then they rented it for a 2-year period and sold it in 2018. So their sale price was $860,000. And their closing costs on this was $60,000. So their total net sales price was $800,000. So they get the $500,000 in cash. Sorry, a little bit more to the example. They had a basis of $200,000. So their taxable gain in this situation was $100,000. So because they got the $500,000 exclusion, you minus the $200,000 basis, and you get a taxable gain of $100,000. So since the property was used as an investment for the last 2 years, they can qualify to do the 1031 with that $100,000 gain. So the great part too, and since it was occupied, they get the 121. So they get that $500,000, so they could take that $500,000 of cash. So remember, they rented this thing for 2 years. So they take that $500,000 of cash. They can do whatever they want with it. It's tax-free. Now they can roll that $100,000, and if you take the next slide, they can roll that $100,000. So as you see here, the exclusion is subtracted from their sales price. So they only have to exchange $300,000. So in this example, because they sold it for $860 and they had $60,000 of closing cost, and they have a $500,000 exclusion, they only have to exchange $300,000. And remember, they walked away with they can take advantage of that $100,000 of equity. So they have about a 33% down payment on a new investment property. They only have to spend $300,000, and it will become a totally tax-free exchange. And so now, again, great part, they got $500,000 in cash that they can spend however they like, and they get to not pay any taxes on that $100,000. And they could utilize that to buy a nice investment property that's going to bring them some income. So they took advantage of both codes by renting the property, moving out of the primary residence and renting it. It's a great way. It's a great tool. Again, you see people that have a ton of appreciation on their primary residence because they've owned it for many years and they are in areas that have appreciated a lot. You could probably look at this example. I can point to many people. My parents, for example, have owned their property out here in California since the 70s, and they only bought it for $50,000. And so the amount of appreciation they have on that property, it doesn't make any sense for them to sell it right now because they only get the $500,000 exclusion. Now, if they moved out and rented it for a couple of years and sold it, now we get the $500,000 of cash, and we can do a 1031 for that remaining amount. That's a lot of taxes we're going to defer over the years. So it's really important to look at your options before just selling and potentially paying a lot of taxes.
Yeah, so I think my key takeaway from this was that, hey, listen, if you lived in a property that's really appreciated and you want to go buy your dream home or you want to buy another house, don't rush to just sell this, your primary residence, rent it out for 2 years and then sell it. You can then take the 500 out of this and pay off the loan of your new primary residence. And then whatever the booth is, whatever the rest of it is, a 300, 400, whatever over the 500 is the appreciation, use that to get a rental property. But there is a timing to this, right? So you can rent it out only for 2 years, because if you let that clock go, then you will not be able to take advantage of the 121. I know a lot of times we think, oh, we'll sell this, our house, our primary residence, we've moved to another one. We'll use that to, reduce the debt on this one, but you will have to pay taxes. Whereas if you rent it out for 2 years, you can do both. And I think that's really powerful.
Yeah. Yeah. And what we see a lot of people do is maybe, refinance their primary to, be able to take advantage and buy a new property. And then they move into that new property and rent their existing single family for 2 years. And so then they start building wealth because they're taking advantage of not having to pay any taxes. And they're, deferring a lot of taxes at the end of the day. And so now they're starting to build some real estate investments. And it's a really, really great tool to do that. So again, before you just sell, look at what your options might be. So if you're considering selling your primary residence and you think down the line you want to own some investment properties, this might be the better way to go, is rent it first.
And also, if you've rented your primary residence, think about selling it in the right period, because you lose that window otherwise. And
so when you cross,
I personally did not know this 2 years back, and we lost that window of opportunity.
Yeah. So once you cross into the third year, over 3 years, it becomes an investment, solely an investment, and you can only take advantage of the 1031. You no longer get the 121. So, because remember in the example, you have to have lived in it as your primary for at least 2 out of the 5 years. So once you cross over and start into the 4th year of rental, it becomes a investment property. So you could move back into it for a year and it helps, but that's just a lot of work. So our advice is within the two years, start looking to sell.
So now let's talk about exits, right? Like now, how do we exit? Now we've done this, we've deferred taxes because it's tax deferred and it's not really tax avoidance, correct? So so one option obviously to exit is whenever you sell, you pay the taxes, but there are other ways to do it so that you don't have to ever pay taxes. And I think that's super interesting as well. Let's first talk about the estate planning example, Paul, because I thought that was awesome.
Absolutely. So again, why 1031? what we look at in estate planning and why it's so powerful in today's world is that there is what's called the step up in basis. So the step up in basis is really, really valuable to people who are going to inherit real estate, because if I inherit my parents' property, I get it at it gets stepped up to today's fair market value. So even though they bought it in 1970 for $50,000 and it might be worth $2 million today, if they sold it, they're going to have a bunch of taxes to pay. And if I inherit this property, if they pass and I inherit it, I get it at $2 million. I could sell it the next day and pay zero taxes. So the step up in basis is a huge thing to take advantage of. And why we say estate planning, this is a way you could take advantage of investment real estate. And we'll talk about more about how you could potentially buy a dream home that you may eventually want to retire into, or a vacation home that you want to be able to take advantage of, maybe an Airbnb situation. It can also help if you have kids, because I can say this much, dealing with this on a daily basis, I get many calls where people are saying, hey, listen, I eventually have 2 kids. Maybe they don't get along that well. They're not good to do business together. So I'm going to sell this one piece of property, and I'm going to buy each of them their own investment property. This way they don't have to worry about dealing with each other. So I'm going to 1031, and I'm going to give each one of them a property they're going to eventually inherit. And so when they inherit it, they each get their own, and they each can either keep it or they can sell it the next day because they get the step up in basis. So the step up in basis right now is really, really valuable to people that own investment or own any type of real estate for that matter, because it's really a good estate planning tool, and it's something to be aware of. A lot of people will say, hey, I'm going to sell this property so I can give my kids some cash. Well, really, they should think about just letting them inherit the property, because it's going to be more valuable to them than selling them and giving the cash.
And I think that's an interesting difference between gifted and inherited.
Yeah. So gifted will assume the original basis, right? So if I was gifted my parents' property today, I would assume that $50,000 basis or whatever it might be with improvements. But so that's not going to do me any good if I decide to sell it. Right? I'm going to have to pay a lot of taxes. Now, if I inherit it, I get the stepped up in basis, and it's going to be at $2 million. So it's much more powerful for me to inherit their property rather than have it gifted to me.
So I think one more nuance I'd like to add here is that there are foreign nationals. So if our parents are foreign nationals and they buy a property here in the US, they get rental income on that property. And when you inherit as a US national, the step up in basis applies to that use case as well, Paul. Right? So we just spoke about that.
Yep. Yeah. So that was something we talked about the other day, and I looked into it. Absolutely. So somebody comes in as a foreign national, buys a property, and they own it, and then eventually it's inherited by a U.S. citizen. That U.S. citizen gets to stepped up basis, and will then be able to sell it the next day and not pay any taxes. So all of this really also goes back to doing a 1031 exchange. If you 1031 over and over and over, and you keep building more and more wealth and buying larger properties, if you pass those properties on to your heirs, they get it stepped up and they'll never have to pay a dime in taxes. So it's a really powerful thing to keep investment properties and really understand that when you are looking at your estate plan. So there is a way to never have to pay taxes on those properties. So something to be aware of. It could go away. There is talks about that, but right now it's something to take advantage of.
Perfect. So I think, that's one way to exit the estate planning. What if I don't want to leave stuff to my children, right? And I just want to buy my dream house. How do we go about doing that?
Absolutely. So this is something that people are not super aware of, and it's a really great advantage. It's called the Revenue Procedure 2008-16. So this was something that was passed back in 2008. Basically, it states, and this is oftentimes, and you'll find this if you own investment real estate, you get tired of the 3 T's, we call them: tenants, trash, and toilet, right? People get tired of that. You don't want to keep managing these properties. You end up with terrible tenants. They trash your property every time they move out, and you got to fix it back up, and you're just tired of it. And maybe they aren't paying in time. We know there's a lot of both California and Washington have very favorable tenant laws over being a landlord, right? I mean, being a landlord nowadays is really difficult because people can literally not pay their rent and not be evicted. It's crazy. So after a while, you kind of get tired of that. You don't want to deal with that anymore. So there's a way that you can exchange what we call your dream home. So let's say, you live in Washington, but you want to eventually have a nice vacation home on the beach somewhere. You can go and you can 1031 one of your investment properties into that new property on the beach, and you only have to rent that property for 14 days per calendar year. And the other great thing is you can actually use it for personal use for up to 14 days per calendar year. So this is a great way. And so basically Airbnbs will qualify for a 1031 exchange. But not only will they qualify for a 1031 exchange, they qualify to allow you to use them as personal use for 14 days. And then after 2 years of doing this, you can move into that property, live in it for the rest of your life, and never pay any taxes. So it's a really great way to say, let's say you have a very nice investment property that's been receiving a lot of great income, but you know what? Again, you're tired of dealing with it, and you're coming towards retirement. You want to have a vacation home that you can live in permanently eventually. You buy that property, you rent it for 14 days for each calendar year for 2 years. Live it, you go stay in it for 14 days per calendar year, and then eventually move into it, live in it the rest of your life. You'll never pay any taxes.
Perfect. So I think basically to summarize, to exit, there are 3 ways. You either pay taxes at some point of time, or you use it as an estate planning tool, or there are ways that you can use it to buy your dream home if you don't need the income coming in, right? So I think that's essentially my takeaway. I know we have about 6 odd minutes to go. Maybe we can very briefly touch upon the types of exchanges. So what are the types of 1031 exchanges?
Absolutely. And one thing I will just add to what you just said there is you still can get income, because there's no limit to the amount of time you rent it. You could actually rent it more than 14 days on Airbnb if you wanted. The key on there is that personal use. You got to be careful the amount of personal use you do it, because if you go over the 14 days, now it's obviously kind of tricky for the IRS to track that. But if you're using that property a lot, and that they could deem it as a second property, not an investment property. And so you got to be a little bit careful about your personal use, but the amount of time you rent it is open to you.
Awesome.
We like the 14 days because, hey, if you're buying a dream home that you eventually want to live in, you don't want to have it rented permanent. You probably want to keep it pretty nice. So, so types of exchanges. So there's a lot of different types of exchanges. What we talked about today were the deferred exchange. So that's the most common. There is what's called a reverse exchange. This is for taking advantage of tight markets. So obviously, again, Washington, California are pretty tight markets. The inventory is low. It's hard to find. Remember, we talked about that 45-day ID period. That can go pretty quickly. So a reverse exchange is a great tool to take advantage of being able to buy your replacement property first, then sell your existing property. So it's a way to do this. Again, in tight markets, you might find a perfect property. You might find this perfect dream home, and you can go out and you can buy it first. And then when you sell your existing property, you pay yourself back. So it is a good tool to take advantage of tight markets, or if you find that perfect property you don't want to miss out on. There's also a construction, or what we call build-to-suit exchange. A build-to-suit exchange is a way to buy a property that's less in value. So let's say we use the example of a property you buy. You sell your existing property for $1 million, but you only find a replacement property for $750,000, right? So now you've bought down, and you don't want to pay taxes on that additional $250,000. You can utilize that $250,000 to improve and bring the value of the property up. So you can spend that $250,000 on improvements, and now it comes out to $1 million purchase, and you're going to be tax-free deferral. So that's a great tool, because it opens up your options of what you're looking for, as well as you can take advantage again to really fix up a property. And it might be a great location. It may be a perfect area, because as you know, in real estate, it's location, location, location. It could be a great location, but it doesn't have the equal or greater in value, but it's got potential. And so you can bring it up to make it equal or greater in value by doing a build-to-suit exchange.
So I think these are very interesting, but you have to ensure that you have a QI in between here. The QI will pay your construction crew, right? So
Yeah.
even if you're doing a reverse exchange and you buy your dream house before you exchange, the QI is the one who would pay for that, and then you pay the QI back. So you can't just go and do this on your own and say, oh, now I want to do a reverse exchange.
Yeah, you have to let us know, and we get everything set up properly and make sure we have the paperwork in place. And yes, so the way it works is we will pay your contractor out of the exchange proceeds, the exchange funds we're holding. And it's important because we keep a track record, because the IRS isn't going to walk on the property to inspect it. If you were to be audited, what they're going to simply do is ask us or ask you for your records to prove what improvements you made to the property. So it's important the way we keep track of everything, and we make sure it's all properly done.
Perfect. I know we have 2 minutes here to go, but maybe very briefly talk about a QI and what should one look at in a QI.
Absolutely. So QI. So it's really important when you're choosing QI. So we are, again, a qualified intermediary. We are owned by Fidelity National Financial. So we are the largest QI, and we have the backing of the largest title company. So it's really important when you're looking at QIs for that, to make sure they're safe and secure. There's a lot of QIs out there that are, independent. Now, there's nothing wrong with that. They're all good people, and they're all very knowledgeable, but they don't have the backing like we do. They don't have the E&O insurance, the errors and omission insurance. They don't have the Fidelity bond like we do. We have the largest in the industry. So your property, or your funds are guaranteed. Right? We back it. We make sure they're secure and they're safe. Now, we put them in we put your funds into a very basic savings account, but it's under your name, your tax ID number. They're segregated accounts. They're not all pooled together. You have your own individual account under your name, under your tax ID number. So when you're ready to buy your replacement property, the funds are there. We have, again, the financial strength. We are a large corporation. We've been in business at IPX for over 35 years. We have very, very good employees that do this on a daily basis. And again, I'm there to help walk your clients through the process. What you don't want to, again, when you're looking at these independent QIs, you got to be careful. There's the horror stories of people taking money. It's all a scheme, right? They start spending it on other things, because always with a QI, money's coming in, right? Properties are selling, money's always coming in. So when you go to buy your replacement property, they're just using other people's money to help buy your replacement property. But when the market gets tough like it is today and transactions slow down, well, if they don't have that money to give you because they went and spent it on other things, or they invested it in bad investments, you not only could potentially lose all your money, add insult to injury. There's been situations where these QIs have disappeared because they lost all the money. The folks not only lost all their money that came in, they had to pay capital gains on that money. So really bad situation. So it's really important when you're looking for QIs. I always suggest look for the ones that are owned by title companies. Yeah. We're owned by Fidelity National. First American has one that's owned by First American Title. All major title companies usually have a QI. So I suggest you use those, because they're always backed by a large company that are going to be in business, and your money's going to be there.
Perfect. Sorry, we are at time, so I want to just ensure that we finish on time. Any questions? Does anybody have any questions here? If not, I'll just very briefly summarize. Like Paul said, when you are thinking of a 1031 exchange, firstly, speak to a realtor who knows this space, right? Because it cannot be an afterthought. It cannot be something that you do saying, oh, yes, I've sold this and now I want to do a 1031. And then also cross-check on the kind of QI that you're bringing in. It's very interesting, be it estate planning that you're looking at, or selling your primary residence. So there are nuances here that you can defer your taxes and actually build generational wealth here. So
absolutely. And I'll add to that on as far as your realtor, because your realtor that are familiar with 1031 exchanges understand the timing too. So they know it's very important that you're going to need to start looking for your replacement property and lining that up, because a 45-day identification period goes very quickly. So having a good realtor that understands that and knows that is really important. It will help you succeed and get a successful 1031.
And also ensuring you can negotiate in that and close in the 180 days, because sometimes it can happen that you identified 3 and now you couldn't close on any of them. So even though you planned for it, you could not close, you'll have to pay the capital gain taxes. So So it's important that you have people who understand the entire process. Any questions, anybody? If not, I mean, appreciate this. And Paul, thank you so much for your time. And
absolutely. Thank you.
This was useful for people here.
Yeah. If you guys have anything, always feel free to reach out to me. I'm here to help you out.
Thanks so much.
Great.
Bye.
Thank you.